Welcome to Alternatives in Focus, Livewire series dedicated to bringing you ideas outside traditional asset classes. I'm Hans Lee, and it's great to have you join us. Our guest today is David Stonberg. David is Neuberger Berman's Deputy Head of Alternatives and its Global Co-Head of Private Equity Co-Investments. He is joining us for this series from New York. David, welcome. It's great to see you.
Thank you, Hans. Good to be here.
David, the benefits of diversifying into alternatives are well known, certainly well written about. But in your opinion, why should investors add private equity exposure specifically to their portfolio?
Sure. So private equity historically, if you look at it against the public benchmarks, has pretty much outperformed the public benchmarks over most 5, 10, 15, and 20-year periods. So most investors are looking to add that excess return to their portfolios. That's a good reason to invest in private equity. In addition to that, we've looked at it recently, and you get access to a lot of companies in the marketplace that you just can't access today through the public markets the way you used to be able to traditionally. What do I mean by that? So in the U.S., as an example, there are estimates out there that close to 90%, I think the number is 87%, of companies that have more than $100 million in revenues are privately owned. And private equity allows you the opportunity to access that fast-growing part of the marketplace that you just can't get exposure to in the public markets. So return enhancement plus exposure to a part of the market that you just can't get in the public equities.
You referred to the recent past there, David, but I'm interested to kind of drill down into that a little bit if I can. How has the opportunity set in private equity evolved as we've seen things like higher interest rates, we've seen a withdrawal in liquidity and a slowdown in the M&A and IPO activity? How has all of those macro factors impacted the opportunity set for you?
Sure. So starting in really about the back half of 2022, we saw a pretty sharp slowdown in private equity deal activity. By some estimates, deal activity down 25 to 40% across the board. Some areas more than others, venture in particular probably slowing down more than that. Personally, I like the environment that we're in. Why do I like the environment we're in? Well, on one side, you have buyers who are pretty disciplined right now, right? They're sitting on a fair amount of capital, but they're showing good discipline. That's evidenced by the slower deal flow. Same thing on the sell side. And by the way, the sellers have a lot of pressure, those private equity firms, to return money back to their investors. So there's good discipline in the market from both buyers and sellers. Transactions are taking a little bit longer. And as a buyer, I think that little bit of extra time inures to the benefit of the buyer. Macroeconomically, we feel like we're in a pretty good place right now. Ability to crystal ball 6, 12, 18, 24 months. So I'm feeling pretty good about the market environment that we're sitting in.
David, in researching for this interview, I've read in the financial press that once upon a time, private equity investing leaned, if not heavily, then certainly leaned on the ability of financial engineering, increasing leverage, dividend recaps to accentuate returns. As somebody who has worked in this space for decades, I'd like to ask you, as somebody obviously sitting at the coalface, was that true? And is that still true today?
So there's no question that was true, right? So what was the mantra 20 years ago in private equity? Buy low, sell high with a lot of leverage, right? And capital structures would often be 60, 70, sometimes 75, 80% debt as a percentage of the overall capital structure. And that created nice returns for a long period of time. That old motto of buy low, sell high with a lot of leverage has now transitioned to buy good companies, make them great. It's a different process. It takes longer. We could spend a lot of time talking about it. But interestingly, although the model has changed, return expectations haven't, in my opinion. We see what these private equity firms are underwriting to. It's just different ways of generating that return profile.
Okay, well, that's excellent to hear. You talk about buying good companies and wanting to make them great. You are also the perfect person to ask about this. What do you think makes for a high-quality private equity investment?
Right. So in today's marketplace, I think most of what you're seeing, and everything I'm talking about is generalizations, right? There's going to be exceptions to everything that I say here. But broadly speaking, buying the good company and making it great, what does that require? That requires a private equity firm who's very skilled at all of the activities that it takes in order to do that, how to take a good business and make it more attractive to the next owner. They bring in operating executives to do that. They bring in operating advisors who help to do that. They have many of the skill sets themselves to do that. So they're looking for already, is it a good business? What does that mean? Is it in a good industry? Is it growing faster than GDP? Is it low commodity exposure, less cyclical, free cash flow, all of that stuff, right? We can talk all about all of that. But then how do they implement that value creation plan to accelerate earnings and or make it more valuable to the next owner of that particular asset? That's the type of deal that we're looking for in today's marketplace. I think that's what qualifies as an attractive investment opportunity.
You talked to deal flow earlier. I'm wondering if I could pick up on that. What do you think is the key to gaining access to really good quality deal flow, especially in times of uncertainty?
Yeah. So I think getting access to high quality deal flow is true whether in an uncertain market or a certain market, right? So in the market that we're sitting in today, and really across all markets, it starts with having relationships with the leading private equity firms in the world, right? That's job number one. We're an investor with over 700 private equity funds. We sit on over 400 LPACs. So we establish the relationships with the GP first, where we're someone that they want to reach out to and call on those co-investments. After that, then you need a team that's able to diligence those investments in an efficient manner and not take up too much of the time of the lead private equity firm in an inefficient way. We have over 80 people around the world working on sourcing, diligencing, and executing on transactions. So it's a big team. You need to be able to come to the table with the right amount of capital for those transactions, which we can do with our pools of capital on the co-investment side. And then finally, you need to be a good partner. What does a good partner mean? It means being responsive, acting quickly with them, being not necessarily quick with yes, but quick with giving them guidance as to the things that you're working on that particular transaction. We do that, having said that, recognizing that we say no to close to 90% of the deals that we look at, right? So it's making sure that you're communicative and that you're responsive, and they need to know that you're dedicated to this activity. I think all of those things are important to being a co-investment partner that firms want to work with.
So as I mentioned at the top of this interview, David is Neuberger Berman's Deputy Head of Alternatives and specifically co-head of co-investments. So you'd be the perfect person to ask this. What are co-investments? What are the different types of co-investments? And why do you like them?
Hans, thank you for asking the question. What are co-investments? So co-investments, simply put, are an opportunity to invest alongside a lead or control private equity firm in a transaction that they're otherwise doing. So let's just make an assumption. There's a private equity, a middle market private equity firm in the U.S. that's buying a company. The deal requires $200 million of equity to get the deal done. They want to put in $120 million. They need an additional $80 million to fill the equity cap portion of the cap table. And they're going to look for co-investors to participate alongside of them in that particular transactions. What are the types of co-investments? The way we look at it, there are basically three broad buckets to that. One is what we call traditional, and that historically represents, call it about a third of the capital that we put into co-investment opportunities. A traditional co-investment is exactly what I just described. The private equity firm has signed up the deal. They've closed the deal. They're coming out to, broadly speaking, LPs who have expressed an interest in co-investing, and they're saying, hey, Neuberger Berman or others, would you like to co-invest in this particular transaction? Bucket number two is what we refer to as a co-underwrite. A co-underwrite is the exact same thing as that traditional co-investment, but instead of reaching out to us when the deal has already been signed up to or closed, it's the same sponsor, the same company. They're calling us and they're saying, hey, Neuberger Berman, do you want to co-underwrite this deal with us? Now, make no bones about it. That lead private equity firm is still leading the deal. They're setting the valuation. They're setting the capital structure. They're figuring out the right management team. They are in control of that transaction. On those co-underwrites, we get, typically speaking, a longer diligence period, more time with the management team, more time with the private equity firm. We find that those are, generally speaking, richer diligence experiences. The third bucket is unlike, and I would say both those first two, traditional co-underwrite, are at time of inception of transaction. The third bucket is midlife, which is not at time of inception. That is, the private equity firm has owned it for 3, 5, 7 years. We're co-investing at that point. Why would they need a co-investor 5 years into a deal? It's going to be typically one of three reasons. One, they need capital to support a material acquisition. Two, they want to sell it from an old fund to a new fund, and we're going to come in and support new fund in the acquisition. Or 3, maybe they want to sell 5, 10, 15, 20% of the existing portfolio company, but still own 89% of it and still continue to create value in it. So that's how we think about the 3 buckets. Why do we like co-investments? I could spend a long time going through that, Hans, but to get to it quickly, what I would say is you're getting access to the leading private equity firms in the world. We're seeing terrific deal flow from them. Right now, we're pacing at 11 plus co-investments per week, many of those coming from the leading private equity firms in the world. We get to be selective about the ones that we participate in. And then on top of that, they're very fee efficient. So we really think co-investment is a terrific way to access the broad private equity market with diversification.
11 investments a week. Wow. So with that in mind then, you are also a good person to ask this. Can you maybe talk us through the life cycle of a previous co-investment that you have made, and what was the catalyst as well for the exit?
Yeah. So, and these really span all the different types of co-investment opportunities that you can think of, going back 20 plus years ago to the, buy low, sell high with a lot of leverage. And sometimes you had those opportunities, you'd buy that business and it would cyclically turn around and you would exit it. In today's marketplace, that's less of what you would think of as the traditional deal that's in the marketplace. I tend to think of, as an example, one of our midlife transactions, where a sponsor owned an asset. They'd owned it for 5 years. It had done very well for them. They wanted to do a material add-on acquisition. We came in with the equity capital to support the material add-on acquisition. That material add-on acquisition unlocked value because there was so much synergy in it, and it strategically changed the course of direction for that company. At the very next board meeting after the close, we were talking about interviewing bankers to go and sell the company, right? So when you think about that from a midlife transaction, the ability to effectuate change to position a company for sale, those midlife opportunities very often have the ability to create that type of momentum to go forward to an exit.
Perfect. So to wrap this all up in a nice little bow there, David, moving forward, what sectors or themes are really most appealing to you as an investor?
Sure. Within the world of co-investments, what we're seeing, and really in private equity, there's this interesting dynamic that's going on. Remember, I talked earlier in this conversation, Hans, about sellers being disciplined and buyers being disciplined and deal flow being down. And as part of that conversation, talking about how LPs are demanding from their GP partners distributions. And we're sitting in this environment right now where liquidity is a bit slow. Distributions back to LPs is a bit slower than it has been historically over the last 10 years. So we're finding ourselves in an interesting opportunity where we can be a liquidity provider to those private equity firms and help them solve issues and problems that they're having, not with the portfolio companies. The portfolio companies are great portfolio companies, but it's in terms of creating distributions to their investors while they still don't want to sell the company overall. Those midlife transactions being a perfect example of that. Continuation vehicles or GP-led transactions being a perfect example of that. Preferred equity, minority equity. So it's really that's where we're finding the sweet spot of the market today, solving for the pain point of the illiquidity in the marketplace between buyers and sellers right now in private equity.
David, this has been a fantastic conversation. Thank you very much for joining us there. That's David Stonberg of Neuberger Berman in New York. Thanks, David.
Thank you, Hans.
And thank you for joining us. If you want to catch more of our Alternatives in Focus series, you can go to livewiremarkets.com. We'll see you again soon.